Thank you very much, everybody. Apologies for this another week for 2 minutes. So, thank you again for joining us today for this panel of AI for market-based finance for net zero. This is part of the King's Festival of Artificial Intelligence 2025, and this festival has been organized by the King's Institute for Artificial Intelligence. This is the third year organizing this event. So, I am Raul Rosales, I am the co-director of the Net Zero Center at King's College, and I've been working in the financial industry for 30 years. And I am delighted to chair this timely and forward-looking conversations with this outstanding group of speakers. So, I'm going to make a very brief introduction, putting into context this so complex and interesting discussion this afternoon. So, first of all, net zero. Reaching net zero is not only a target, okay? It's also a significant opportunity. It's a driver of the energy transition, a catalyst for clean technology deployment, and a key pillar of energy security strategies worldwide, but mostly for the UK and Europe. I want to highlight these 3 points in the context of net zero, because that's the context. And to deliver on this, we need more than breakthrough innovations in the space of either engineering, as we are doing here and other universities across the world, or innovations in carbon removal or emissions reduction. We need more. We need the ability to translate engineering and technology innovation into the real economy at the scale. This is what we need. And that means making solutions viable, affordable, and investable. Because we come across that we have technology readiness level, several kinds of clean tech technology, but we cannot deploy it into the market because of the capex investments and other kind of barriers that we are going to talk about today. And this is where market-based finance for net zero, plays a vital role. This is why we chose this title. It connects the dots between market-based policy mechanisms, such as, for instance, carbon pricing, emission trading schemes, carbon contracts for difference, tax credits, carbon taxes, all this kind of, in the space of climate finance, with this kind of financial instruments, clean energy technology, and other financial instruments needed to mobilize private capital, whether through carbon markets, transition finance, or blended structures. I am using very, very particular and very concrete terms because it matters, so it is more important than looks like. I have to say as well that central banks, like the Bank of England, ECB, and other supervisors, use the wording as a policy mechanism as well, and they use it as well, I have to say that. How about the barriers that I am mentioning? There are significant barriers. Technologies are at the start. Sometimes we have this kind of market readiness, but one of the main barriers for this kind of clean tech solution we have for engineering developments is the capex investments. The investment required. And decision makers, I mean, policy and finance decision makers struggle with lack of understanding, on the one hand, of the technology, and also we come across with fragmented or delayed market intelligence about this. So, and this is where artificial intelligence could make and makes a real difference already. Not could, makes a real difference. AI can help us unlock faster, more active, and more targeted finance support, the design of scalable deployment strategies, and enhance visibility on technology readiness, policy risks, and market dynamics. We are going to talk with in very precise sectors, hard-to-abate sectors like the cement, steel, methanol industry, because we are already working on that. And I have to say as well that in the space of universities, King's College, or Imperial, depending on the Professor Rie here with us, all the kind of research we do is in collaboration with the industry, 100%. We work with the industry, and with real data. So, I want to say as well, just to mention what some institutions like, for instance, the Bank of England, two regulators and supervisors are doing, the Bank of England and the Monetary Authority of Singapore, just to give you some figures. The Bank of England and the Financial Conduct Authority, FCA, conducted the third survey about AI and machine learning last year, 2024. I'm going to give just a few figures. Use and adoption of AI and machine learning by financial institutions in the UK. 75% firms already using AI, with further 10% planning to use AI over the next 3 years. Just to give some figures about what we're talking about. Another point, third-party exposure. A third of all AI use cases are third-party implementations. So, third-party doing that. This is an important point as well. And finally, understanding of AI systems. 46% having only practical understanding, and 34% complete understanding about AI. In terms of the monetary authority of Singapore, which is the financial regulator in Singapore for banking, insurance, and asset management, they allocated $100 million last year, about 75 US dollars, to help financial institutions build their quantum and AI technology capabilities. So they are investing in that. They set up this kind of a grant scheme, which is called Financial Sector Technology and Innovation Scheme. And under that scheme are fostering and helping financial institutions developing their internal capabilities in terms of AI, risk management practices, governance, and so on. So the objective of this panel today is to explore how AI can support the evolution of market-based finance in the service of the net zero transition, as we mentioned at the beginning. How AI can help on that? By enhancing tools, for instance, some algorithms or other kind of decision models that we work with, informing decisions, and ultimately accelerating deployment. Well, we have these outstanding 4 speakers. We have Professor Demi Uruleye, lecturer at the Grantham Institute for Climate Finance. Professor Uruleye, she's the market-based lead in green finance or clean tech at Imperial College. So, Professor Camille Ventre, Professor of Computer Science and Chair in Computer Finance. He's the Director of the Department of Informatics and also the Director of the King's Institute for AI. We have with us as well Af Nahora, the CEO and founder partner of Readiness AI, a successful entrepreneur, venture investor, and Alex Baker, the Chief Technology Officer of Orchard Global Asset Management. The 4 of them are quite different in terms of the approaches, how they are working on this. They have a common denominator in terms of they are quite entrepreneurial, the 4 of them, I know a little bit. And, but it will be a very, very interesting discussion. And in terms of the Q&A we have prepared, and we will be glad after the questions that we are going to address now to listen to you and to respond any questions coming from the floor. We'll be glad. I'm going to ask right now to the 4 speakers to very kindly to introduce themselves and to respond at the same time like a big question, helping to put into context to the discussion, which is, what is the biggest opportunity you see for AI in advancing market-based finance for net zero? Let's go to start with Camille Ventre. Camille?
Yeah, thanks, Raul. Yeah, I don't need to say more about myself. But yeah, so I think from my own research and we have used AI in this space, I think the biggest opportunity is the extent to which AI or the potential that AI has to bridge the gap between policy design and actual market behavior. So in the research we've done, I think 3 main aspects have come to the fore. The first one is that AI can be used to design policy sandboxes where actual policies are tested before they're actually implemented. And this will allow to reach conclusions on which policies work better for the system design, for the system objectives, sorry. And the second is what I would call strategic adaptation. So it's, we know that in markets, actors are mostly rational, and the key word is mostly. So the AI and work we've done allows us to study also the strategic adaptation of agents to different policies and how these will reflect into the system outcomes. And the third is engineering by design what the system output should look like. So in the rest of the panel and in the next answers, I think I'm going to be able to add a bit more details to these 3 items. But ultimately, I really think AI could help us get smarter systems rather than fixed policies that may or may not work.
Okay, good. Thank you very much.
Thank you. So I'll probably give a big background to myself and then answer the question. So at Imperial College, I lead a research lab called Market Interventions for Deep Decarbonization. What we do is develop bottom-up data-driven optimization models and algorithms to evaluate how market-based mechanisms can improve the economic viability and accelerate the deployment of deep decarbonization solutions. So market-based mechanisms are from the public sector, so taxes, emission trading scheme, carbon contracts for difference, subsidies, as well as from the private sector, so you could have advanced market commitments. So we look at deep decarbonization. What I mean by deep decarbonization are those clean tech that can drive or move the needle in heavy sectors, so shipping, aviation, steel, cement, chemicals, petrochemicals, and these technologies of green hydrogen, blue hydrogen, CCS, direct air capture, synthetic fuels, and sustainable aviation fuels. There are so many, so that's why my expertise is in systems modeling, so bring them together and find the connection where they intersect, because that's the best way to intervene in this sector. Now, to answer the question, there is, so far, at least there's evidence that existing market-based mechanisms have not necessarily supported the adoption and the diffusion of these deep decarbonization solutions. Because either the carbon tax is too low and we're just generating a lot of revenues for government, but it's not necessarily supporting commercialization of deep tech. So AI can be used to support that discourse by looking into bottom-up granular modeling of what's happening in industrial sites, what's happening with these technologies, to understand their cost, to understand the cost of capital associated with these technologies, and then design dynamic policies, a mix of policies, hopefully, that will be effective, and accounting for history, the historical trajectory of these policies and this cost, as well as the future.
Good. No, thank you very much. Excellent summary in very few words.
Yeah, sure. Thank you for inviting me here today. There are about 40 people sitting in this room, so we've got 40 additional brains on that side analyzing us. I'm the founder of a company called Ren, which is an AI business that was funded by the UK government last year. And the problem we're looking to solve is around accessibility and, I guess, the democratization of ESG data and intelligence for everyone, not just asset managers and pension funds, but also enterprises and even small companies, academics, regulators, policymakers. And there are 3 major problems in this whole ESG intelligence space. One is there's inconsistent and fragmented data, which is what you're all aware of, right? We're trying to create a standardized view of all of the data on ESG of public companies where possible. The second issue is related to the fact that the companies today that provide the data, Bloomberg, AlphaSense, some of the others, they are terribly expensive and they're on clunky, old school systems. I'm disrupting that with the generative AI. We're building a large language model, if those of you are familiar with that term. The third one is, of course, the cost of compliance is unbearable. You know, it's absolutely disgusting. It costs so much money to do compliance, especially if you do it manually. And of course, the subscription costs of all of these companies that I've talked about just keep going up and up and up and up. So I want to dismantle all of that. Sometimes we call ourselves the DeepSeek moment in ESG intelligence. So I will talk more about that as we go along, but watch out for Ren. And Ren, by the way, has a dual meaning. It's short for Renaissance. It's also a Confucian word from China. It means benevolence or humanness. And we named it that because we should never forget that humans are definitely more important than AI. So there you go.
That's a good point. No, thank you very much, Staff. Alex Baker.
Thanks.
Global Asset Management. You can say something for Orchard as well.
I'll try to give a tiny little introduction to Orchard. So Orchard, for those who haven't come across us, we're not in the headlines too much, hopefully. We are a global asset manager. We specialise in the credit markets. I was interested in a little show of hands, actually, Is anyone actually aware of the credit markets? I mean, most people, when they think of markets, they think of equity. But is anyone, can we have a little show of hands? A few people are aware of the credit markets. So the credit markets are, orthogonal in some ways to the equity markets. And, at times work in an inverse sense. So flights of capital can move between them in an inverted way. So Orchard are kind of nose to tail in the credit markets. So we have businesses that focus on credit derivatives, so super liquid credit indexes, bespokes, tranche trades, right the way through to private credit, which is obviously a very de jure part of the markets globally at the moment. I was curious, my background is not in net zero, just for full disclosure. My background is in technology, and my background is very much in AI and in credit. And I think when Rahul was opening, I was reflecting, I think, by analogy on how the credit markets were enabled by technology, almost as an analogy for how net zero could be enabled by technology. The credit markets came into fruition, I guess, during the 90s. And really, there's a very close analog between the way that the credit markets have exploded globally, for good or bad, during 07, 08. But that growth was really underpinned by a significant technology enablement, both in terms of pricing, risk management, compliance costs, and yes, I do see the budgets for compliance, and they are quite large. So the whole ecosystem of asset management has been really underpinned by technology and credit. So I think if there's a parallel here, it's that technology enablement can be the driver and the kind of successful partner for change in new markets. In terms of the limitations, perhaps, of AI, to focus on it in a slightly more contrarian view, what is AI not good at? What would it not be good at in terms of enablement? And to answer maybe a slightly contrarian view, I think what AI is not good at, perhaps, is judgments and knowledge-based work. And I think, when I engage with people across Orchard, there is some hesitation that maybe, AI is a negative force, perhaps, that will provide such efficiencies that maybe people are scared about their jobs. But moving the function of people's jobs to knowledge-based work, I think, holds true. I see that as a truth, and I believe that. What else is AI not going to empower for us? Well, I think it is going to provide, it isn't going to provide judgments, efficient judgments. But, I'll ask this as a question, is AI only based on knowledge that's been known before? Or is this based on new knowledge? And if it's only based on knowledge that's known before, does that restrict us in some way? So, I don't have a definitive answer for that, but just sort of decomposing it in a few different sort of contrarian ways as to, what is AI not going to be good at might be a useful way to view this problem.
Good. Thank you very much, Alex. Now, it looks like pretty clear that we cannot leave AI and machine learning, all these kind of new technologies, which are a reality, we cannot leave it behind because we are very lack of understanding or whatever. Because if we do that in the financial sector, we will be behind or lost very quickly in 1, 2, or 3 years. So all of us, we need to work on that because we are talking about data, integrity of data, clear data, this kind of bottom-up approach, in terms of other things, in terms of credit risk modeling. So this is happening very quickly, and this is why financial institutions, asset managers, insurance companies, banks need to work on this, the business model, risk management, internal models, and so on. Now I would like to start to deep dive into this discussion with our panelists and speakers. We are going to start with Cabinet. Cabinet, I wanted to ask you, how can AI help policymakers design more effective market-based mechanisms for reducing carbon emissions? I've seen in your recent work on carbon allowance options, which is titled Equilibrium of Carbon Allowance Options, Emissions and Productivity, which, by the way, is quite timely, bearing in mind the discussions between the UK and the EU in terms of the linkage of the emission trading schemes between the UK and the continent now, happening last Monday as well, but also how can AI help investors as well?
Yeah, okay, thanks. So I think I'm gonna come to your question on whether AI can only learn what's in the data already, right? And I think it's what the definition of AI is. And in this particular paper that Raul mentioned, we're not using AI machine learning, so we are producing new knowledge in the sense that we are looking at the EU ETS auctions that I hope people know here. So this is a market-based approach by means of which the EU allocates licenses to emit CO2 in the air. And it's a market-based approach, which means there is an auction and there is some rules in that auction. And there's some rules around how much should firms be charged, what the decay rate of emissions is going to be, what the actual numbers, or even how much should the EU charge companies that emit more than the licenses they acquired. And what we discovered with AI is that if you look, for example, at two different ways of pricing these licenses, either everyone pays the same price or everyone pays the price they bid for the actual license, the kind of system-wide equilibrium or outcomes are going to be different. And if you want to really reduce emissions, you should go for, I think it was uniform. Whereas if you want to have a fairness between all the players in the markets, it seems that discriminatory prices work better. Now, this means that AI now gave new knowledge that we didn't know before. And as I was saying in my opening, answer, this is a way of testing policies potentially before they are going to be implemented. And for example, what's the right decay rate to reduce emissions as much as possible? That's a question that with the tool we've developed, you can answer. And if you look now at the individual, because you had also a second part of the question is what could individual firms do? Now, by having this tool that allows to study the market, individual firms can start doing counterfactual analysis. What would have happened if I bid more for the licenses? Would have gotten more permits or fewer permits? They can also do adaptive learning, which means they can use this system to come up with more clever strategies. And for example, in our one limitation of our current work is that the strategies of the firms are fixed, so they decide in which way to bid for the permits, but there's also another world whereby these firms are going to be more clever and they're going to change their bids depending on the market situation. Overall, I think AI can help firms become active players rather than passive players, just accepting the policies.
Okay. No, this is interesting. For instance, there are US investors investing right now in the UK allowances for the ETS instance. So,
yeah, and potentially you could use it also to start the linkage questions, actually.
And the linkage, for sure.
What I'm thinking is that you can take what we developed for the EU and you can take another system for the UK and you can study what the linkage would do.
It would be very useful, even, I have to say, to overcome some political barriers there are for that.
Yeah, you're too optimistic.
I am too optimistic.
Yeah, I don't think research will do it, but yeah, anyway.
Yeah, so, good. Now let's go to move on with Moby. Bemi, based in all the research you are doing, as you described so well at the beginning in the introduction, I wanted to ask you, what is the role of market-based mechanism in financing the net zero transition? How do they generate demand pool, this kind of demand pool, and pool financing to create viable conditions for clean tech commercialization and private sector investments?
If you look at the trends of climate finance, the gaps is in pool financing. There's a lot of push financing, so project-based finance, but there's no pool finance. Without pool finance, you cannot change the dynamics around the price of cleaner products and the cost of technologies so that developers of these technologies have a viable business case. So for instance, if I use green hydrogen is probably 5 times the price of natural gas. With push finance, you can establish a green hydrogen project. You can bid, you can get a grant, but you still need to do something about that price gap. This is what market-based mechanisms are supposed to do. So you could put a tax on natural gas to increase the price, or you could incentivize green hydrogen. And this applies to a lot of clean technologies. So the role of these market-based mechanisms is to close that gap so we can generate demand pool to scale. Now, the way it works with clean technologies is if there is a strong demand signal, then you can build out and further reduce the cost. So for instance, 1 kilowatt of hydrogen, 1 kiloton of hydrogen production will cost X. If you ramp it up to 10 kilotons or 10 megatons, it will cost half X, 0.5X or less. So that's what demand signal does. Now, if you study the history of electricity, UK has done well with greening the electricity grid with renewables, and it's been policy support for over 30 years. And you see again the mix of push and pull contracts for different feed-in tariffs, renewable heat incentives, where the pool finance or market-based mechanisms used to support the electricity sector. And there are a lot of push finance as well. But beyond electricity, when it comes to the molecules, when it comes to clean tech, we still struggle with that lack of very strong market-based mechanisms that go beyond just generating revenue for government, but creating an incentive for industry to invest. So it creates a strong demand signal for the project developers to scale, and that will bring about cost reduction for the wider economy as well. I mean, with very strong market-based mechanism, we can achieve positive economic tipping points where that gap between clean tech and the business as usual is bridged before we get to climate tipping points where it becomes very disastrous.
And also for the price signal as well, which is coming out from that.
Yeah, so today what we've seen is, yes, the market-based mechanisms generate revenues. I mean, the ETS, the UK ETS, EU ETS, there are 8 ETS schemes around the world. There are a lot of carbon taxes, the highest in Sweden, but it hasn't successfully accelerated the adoption of clean technologies. There's an argument that the prices are too low. For the assessment we did for the ETS to support the adoption of deep decarbonization technologies, we need to triple the price. Of course, the economy cannot afford that, and that's why developers should be given the option of stacking up these mechanisms. You still need a tax, an emission trading scheme, you need a carbon contract for difference, different ways for them to bridge that gap. There's still a role for technology innovation, but a lot of the data and research has shown that even if you develop the perfect clean technology, 100% efficient, good, sustainable materials, it still wouldn't be as cheap, in quotes, as the business as usual. Of course, we can question the word cheap because we've not been able to internalize the externality, the cost of cleaning up the business as usual. This is where a tax comes into play. So to answer the question, market-based mechanisms, in my opinion, are the ultimate pool financing tools to really bridge that gap so we can improve the economic viability of these solutions. And that will lead to their commercialization as well.
Understood. Absolutely clear. Absolutely. Thank you very much, Lenny. And let's start with you and with this point of view of market intelligence and decision making. And with your Readiness platform, which aims to simplify access to global ESG markets data. We're talking about this, there are about 30 taxonomies in terms of ESG working for us, and over more than 1,000 regulatory frameworks in the world working in the space of ESG. So, with all the kind of political connotations of geopolitical shifts at the same time, which is like a policy risk. But in this kind of with your platform of ESG market intelligence, in the context of market-based finance for net zero, how do you see your Renaissance AI platform capabilities influencing investments and policy decisions, particularly in fast-moving in this kind of currency, not only geopolitical things, but as we mentioned, so many different taxonomies which does impact the risk management of the investments, but also the policy approach and regulatory.
Okay, great. So that's a great question, a big one. I'm going to try and answer it in parts. I became a founder in my last venture because I had a purpose. I've become a founder in my existing venture because I have a purpose. And my purpose really is to simplify the access to this intelligence, right, like I said earlier on. And one of the problems in this industry is pretty much, I think my colleagues there were speaking about, I would call upstream measures and changes. I'm talking about downstream. In fact, what I'm doing is terribly simple. It's really not that complicated. I figured out that I've got to occupy a space in the market. Someone's got to do it. I decided to do it. And I'm leveraging timing. It's the fact that generative AI models came out 2022 with OpenAI, and the fact that now generative AI, unlike AI, and by the way, the difference, the way I separate the two, just for simple explanation, AI for me is a person. Imagine a person called Rishi, no pun intended. Someone called Rishi is AI. AI is a super IQ individual that can compute anything at rapid rate, and it can do predictive analytics, and you give it anything, a 0 and a 1, and it's absolutely brilliant. It can predict anything with input, okay? Generative AI, let's call generative AI Rachel, again, no pun intended if you're following politics, and generative AI is generating new stuff based on text. It's a text-based model, mostly, as opposed to just a numbers-based model. And what generative AI can do is it can ingest information from different sources, like PDFs, and extract all of the words and the data points from PDFs, put it in one place, in different form factors, like you can have data visualization at a pace that you never imagined. You can have Excel sheets built out from existing PDFs and Excel sheets that we've never really been able to do. It's been a manual process, a more old school process. And all I'm trying to do is take all of the world's ESG disclosures from publicly listed companies, hold them to account, make sure everything that they've published. By the way, this is the weirdest thing. Public companies publish information on ESG. ESG reports, gender pay gap reports, human rights disclosures, materiality, and so on and so forth. And it's on their website. There is no one place where you can go find that information. It's the most bizarre thing. And in every jurisdiction, to add more complexity, you go from the United States to the UK to Europe. Every company has it on its website. And imagine if you've got to do analysis and gathering the data. It's an absolute nightmare. In fact, Bloomberg did a study in 2023 with analysts from asset management organizations who said they spend 50% of their time gathering the data, forget analysis. So you can see the productivity drag that exists out there. All I'm trying to say is I've built an AI brain that will standardize, maybe semi-real-time access to all of the data on all of the public listed companies. Why? Because you can do due diligence, you can do competitive intelligence if you're an enterprise. If you're an asset manager, you can de-risk your portfolio strategy, maybe even look at, to your point, a better capital allocation. And I'm actually solving that problem. That's what I'm doing to make policymakers, regulators, enterprises, and also investors make better decisions on ESG. So that's what I'm trying to do. So I don't know if that answers that question.
Definitely. No, there's plenty of work to do in that space because we need the standardization with ESG in terms of the taxonomies, in terms of the regulatory approach, and also in terms of the regulators themselves.
Yeah, absolutely.
To be on the same page and to be fully aligned. And this is where the technology can help to level the playing field for that.
Yeah, I was told when I was doing my first degree, I did anthropology years ago at a place called Goldsmiths. That's when people said, what the hell are you doing anthropology for? It's a useless degree. And now it's very popular, of course, because now if you do anthropology, you're super cool and got a big brain. It's funny how timing makes a big difference. But I think, for me, if you have a level playing field in your ability to access data, you can do some very smart and clever things. We're not even there with ESG. We're not even there. And I think the points Carmine is making and my colleague here is making, very well articulated. I mean, I think there are, government policy makers, I can tell you right now because I'm working with government, even they don't have a joined up view of what global organizations are doing. They don't even have a joined up view of the data, like what is Barclays doing versus HSBC versus Santander versus Wells Fargo. There is no central way of doing a clear comparison. And the ones who are doing it really well have to pay a lot of money to some of the big data providers. Let's fix that problem first. It's a basic problem. Let's just fix the simple problems. Then we can do all of the cool stuff that we're meant to do. So that's my view.
No, thank you for that. Now, Alex Baker, let's go to address just with another different angle. I wanted to ask you, what success factors are critical in establishing, this is challenging, as you know very well, in establishing successful change, especially around AI capabilities, in particular with focus on achieving net zero? What are your views on that?
I think there was one point actually prior to answering that question I just wanted to pick up on regarding simulation. And certainly, you know, as part of my role, I look after a manager, quantitative team. Simulation is, you know, at the heart of all financial investments. And one of the kind of anecdotes in simulation, you quite often find quants will come up with a fantastic strategy, and it generates a huge amount of alpha when they backtest it. It's fantastic. They trade it, and what happens? It fails. It fails, and it fails for a common reason, which is overfitting. And I think when we talk about any simulation, whether it gives us new knowledge on uniform distributions or binomial distributions, we have to treat it with some skepticism that perhaps this is overfitting. Perhaps LLMs are just a very sophisticated way of drawing a line through lots of points. I think they're probably a little bit more than that, but at some fundamental level, they probably are that. In terms of change, a large part of my role working for a global company is managing change and managing complex change. And I'd say there's probably two facets to that change, both complication in terms of layers of change, but also horizontal connectivity. So complex change in terms of lots of connections, but lots of layers of change as well, so lots of layers of complication. Quite often, once people agree that there is change that's required, that's a great first step. Gathering people together to actually create viable change in terms of an alternative approach, again, is sometimes a fantastically difficult task, but not the final hurdle quite often, sadly. I quite often think of it as being in a kind of river, and you're kind of trying to swim across the river and land your change on the other side of the shore. But you quite often get pulled back by lack of change adoption. And I think that's quite often one of the biggest barriers to actually landing successful change. And I fear it's symptomatic of all change, and probably symptomatic of the change we're talking about trying to achieve today. So I think there's lots of challenges, but they shouldn't put us off. But certainly in terms of simulation, we should look at AI and be skeptical, I think, in terms of making sure that our simulations are rigorous and fit for purpose.
Okay, good. Thank you for that. So let's go to speed up just because I have like 2 questions for each of you if you have time. But anyway, let's see if we can. So coming in, you also very recent research in the space of the green disclosures and ESG. AI revealed how firms respond to ESG policies. Again, with ESG things. Okay, you can see that we are talking about ESG approach, data, with this type of market intelligence and solutions, and this other kind of approach with maybe correlated with market-based and bottom-up approach in hard-to-abate sectors that we're going to talk about now. But in this kind of green disclosure research, how can AI bridge the gap between theoretical policy design and real-world corporate behavior?
Yeah.
They mind this kind of there are critics about some potential threats or risks in terms of transparency, how to ensure the fairness and transparency of all these kind of things, and Also,
Yeah, easy questions.
algorithms, no?
Yeah, good, easy questions that I can answer very quickly. Okay, so yeah, the simulation angle, it's not just simulation. I can tell you that, but I agree. Of course, you can simulate whatever you want if you try hard enough. But it would become too technical. But regarding the ESG policy, we imagine a world where upstream of having ESG data is everyone has it, and then as a policymaker you need to decide which kind of disclosure policy firms need to use. And we imagine there are 3 categories of firms: dirty firm, low green firm, and high green firm. It would be a tool that will be able to tell us that. And of course, changing gear comes with some cost, and depending on your color, you will attract investments from the market in a different way. And what we compared is the simple, strict policy disclosure. You need to tell the regulators whether you're dirty, low green, or high green. We also have a different policy whereby it's a 2-step process, by means of which you can say you're either dirty or green. Notice that this one now allows for some greenwashing, right? So you can be a low green, but you appear to be high green. And then we have the second one, which we call a mixed one. So in the first step, you either need to say whether you're dirty or green, and in the second step, you can also say whether you're low green or high green. And then we were able to, Simulation Plus or clever simulations, to find out that this mixed policy, the one that I said at the end, is the one for which the majority of firms would upgrade to high green policies, high green processes. And this is bridging the gap now, right? So we are able now to say with some confidence, and I agree, of course all research is research because it's not been deployed, but with some degree of confidence we can say that this mixed 2-step process, whereby we ask firms different things in the 2 steps, is the one that we should go for if we want to maximize high green firms. For the second part of your question, this is very hard. So you're saying, how do we make sure that there is no algorithmic collusion or fairness? That's not an easy question. So there are limits to what we can say. And especially, and I'm going to now throw something that's a bit outside the scope here, but if you think about agentic AI, that everyone now is the new buzzwords, agents will do everything for us. We don't know where these agents will converge to. What is the equilibrium of this system of multi-agents? It's not clear at all. And with the tools that I've used for these simulations, you can start getting some sense of where the system will go. And you can try to engineer outcomes through designing the incentives properly in a way that algorithmic collision is not going to be there. Or, as in the example of the SG, all the firms are going to be high green. So this is the kind of research that still needs to be done to avoid the risks coming from multi-agent systems powered by AI.
Understood. Well, it looks like clear as well that we need to develop methodology for transparency, fairness, and...
Yeah, I think a methodology is there. It should start, I think we should just start changing the framing on accepting that agentic AI will come with even greater risks than normal AI. Okay, so the conversation, it's always focused on the single bot, and everyone sees the advantages of having an army of bots working for you, but as much as the opportunities, the risks coming from the interactions of these bots, it explodes. So the methodology, I think it's there. We need to do the research and understand how we can engineer what we want as system designers.
Can I just chime in if you don't mind? I just want to break the format. But about 2 weeks ago, Sequoia Capital did an event somewhere in the United States called Ascent AI. You might know about this, where they got 100 of the best allegedly the best minds in AI. Sam Altman was there, Jensen Huang from NVIDIA, and all of the other bright people. And they locked them up in a room, and they started to figure out together, where will the world go and be in a world of AI? Because, of course, they are the custodians and creators of AI. Let's not forget these people in the room with a lot of money. And one of the topics was agentic AI, agents, essentially, which is basically workflow bots, right, at the end of the day. And my opinion as a startup founder is this, to your point. The first one, I'll assess the risk. But the one thing I love AI, right, obviously. So as I'm listening to all of you, I'm like, nah, don't worry, it's AI, it's gonna be fine. But I do get worried about a few things with AI. The first one is deepfakes, for good reason. We're not talking about deepfakes today, so it's okay, but I'm really scared of deepfakes. The second one is agents, and the reason I worry about agents is because the agency that we have as human beings is our ability to actually do some workflows. Like there's some workflows that we hate doing, like I hate doing home chores, or doing my finances, or paying for bills, or invoices. Totally hate that stuff that drains me out. But there are some things that I like to do. And I like to booking a holiday. I actually really enjoy booking a holiday. I like to go and look at hotels, and this is a nice one, that's a nice pool, I've got 2 kids. I actually like doing that, sad as it may be. And what I worry about agents is that agents aren't just going to be researchers. That I get. That's what I'm doing in my business. Where I get worried is they're going to conduct and transact for you. Potentially, not now, but soon. So you'll be sitting back and decisions will be made for you, be it on the ESG side, even at a worker level in a corporate. And what is the risk of that? And what happens to hiring and firing? It's a bit like when the Tesla came out and they said, if a Tesla kills someone, young child, older child, who's to blame? The insurance company, the creators of Tesla. I think with agents, we're coming there soon, where if an agent makes a decision on your finances or trades a stock for you, not at a institutional level, but at a private investor level, well, who do you blame? Who are you going to get your money out from? So just want to support your point. Agents are fantastic, but they can be terribly dangerous. Final question. Who's recording this session on a GPT or LLM right now? Who's listening to us on GPT LLM? Because if you're not, you should. And you should be asking the GPT saying, what Af just said, how would I counter that point? And are there any other perspectives? But that's how we use GPT in our work environment, by the way. So as students, you should be live on GPT all the time. Maybe that's a controversial statement.
No.
No, I think they already do.
It's responsible use of technology.
Okay. Anyway, let's go to now with Debbie, the second question. Debbie, how can AI enable optimization tools that as we are using now for our research support the design and evaluation of market-based policy mechanisms and interventions like in compliance and voluntary carbon markets, carbon contracts for difference, and so on? And when targeting net zero and decarbonization strategies in hard-to-abate sectors?
So I thought I'll answer that question by trying to join up ESG and net zero. So ESG means environment, social and governance. So under the environmental aspect of ESG is the need to get to net zero. So organizations or firms are trying to reduce their emissions, whether scope 1, scope 2, scope 3. Now, a lot of the organizations or firms or sectors I work with have very high scope 1 emissions. They are responsible. They sit on the scope 1 emissions. So 1 unit of scope 1 emission is equivalent to like 40 or so units of scope 3. If you get rid of scope 1, there will be no scope 3. So if you decarbonize transport, aviation, shipping, or steel, then their indirect emissions will reduce. So that's just the link between net zero and ESG. And to deliver all this, we need finance, right? Now, in my previous life, before I became an academic, I used to design industrial processes, high temperature, high pressure, front-end engineering and detailed engineering design. And one tool I used to deliver these processes, whether it's for production of in refining or petrochemicals, was optimization, mathematical optimization. So we use very advanced tools, stochastic optimization, robust optimization, to understand data data to understand the trade-offs and to provide solutions. And these have been deployed in industry to validate that, okay, it's correct, the data is good. So I did not use 100% AI. I still stick to my optimization methods in designing these market-based mechanisms, but I've discovered that there's so much data. So imagine trying to build a tool for all the sectors, so many technologies, so many fields. The cost is between X and Y, and nobody knows what the true cost is because the cost is dependent on the demand as well. Even the manufacturer will tell you, yes, we know the cost of production, but selling price is down to demand. So we collect all this data. We also collect data of all industrial sites around the world, so not just the UK and the EU, because we must get to net zero globally. And within the sectors, we're talking about international trade as well. So no single country is a custodian of these sectors. I mean, shipping, international shipping. So we get all this data to understand their emissions, understand the cost of abating this emission, also understanding the cost of capital, which is very different from country to country and region to region. Now we process it through the optimization models to say, okay, what's the mix of market-based mechanisms specific to a region, specific to a country, specific to economic conditions to drive the adoption and commercialization of these technologies. And we come out with so many outputs as well, telling us, okay, if the plan is to get to net zero by 2050, how do you cost-effectively diffuse technologies? There's so much data going into the optimization model, so much data coming out of the optimization model, and there's so many uncertainties as well. And we've not been able to predict all this or understand the uncertainties because we're looking at the future. So we've moved beyond stochastic optimization to robust. But in processing the data into the optimization model, this is where we use AI. So we try to make sure that we mine the best data. We try to ensure that we do some pre-processing to make sure that the data quality is good, because there's so much academic data on the cost of technology, industry data, government data. So we find the lowest and the highest and find the average and what's the integrity of the source of data as well. And we do some predictive modeling, like deep learning. I mean, if there is no historical data, it's difficult to train and observe the trends, but we can still do some predictive modeling using the data. Now, once we pass it through this mathematical optimization model, in some cases it has over 200,000 variables, constraints, so the model runs. It's very computationally expensive, so it runs for a long time. And once we get all the data out, you still need to process it. Because again, yes, while you can improve what you measure, you also need to take it with a pinch of salt. You still need that practical engagement. You still need stakeholder consultation to say, this is the trends we've observed, this is what we recommend, what is possible, and go through this stage. But I stop at getting the data out. I can't do everything. So we still need some scenario analysis of the data. Again, the optimization has built-in scenarios, but you still need to integrate reality into the scenario analysis. We still need to visualize the data, especially with respect to uncertainty, because if prices reduce faster than we expect it to, then it'll be too much investment for government and it could skew the market as well. And if prices don't reduce, so direct air capture, for instance, the technology that removes CO2 from the air, initially, we thought the prices would reduce as fast as we've seen for renewables, but the learning rate for direct air capture is very low. So that has changed the dynamics, even within the voluntary carbon market, as well as advanced market commitments, because cost will not fall as we want it to. The final thing is feedback. So once we pass this data through this AI-enabled optimization, then we've got these multiple results we analyze, but we still need to feedback because it's a timeline to 2050. Ideally, you want to spread the investments as well and find the optimal way to do that. So feedback comes from what's happening in reality. Do we need to factor in the social welfare as well? I don't do anything on social economics, but it would be good to integrate that into the feedback loop. What's the social cost of carbon? What about other ways to offset or to reduce these emissions if the solutions are too expensive? What if the costs don't fall down? So there's a feedback loop, and we use reinforcement learning for that.
Good. No, thank you very much. It's amazing this work. Let's go with you now in terms of the model design and governance of your platform. Your Renaissance AI platform with this kind of language model with ESG at its core.
Right.
And how do you ensure that the model's outputs remain aligned with evolving taxonomies, as we mentioned, these sort of frameworks, regulatory products?
Yeah, it's a very good question. So I guess there are somewhere between 600 and 1,000 different standards and regulations around ESG. It's very confusing. And when I speak to people who have to do the compliance around it, they speak about different verticals, different industries, different jurisdictions, and so on and so forth. And it's very hard to figure out whether you are compliant and to what extent. There are some good things here, though. A GRI, which is the global sort of reporting standard, and we are partners with GRI. We have to pay a license fee for that, but we are a partner, and we're using GRI because 90% of S&P 500 companies use GRI. And then there are other mechanisms like directives like SASB, the Sustainability Accounting Directive, and of course CSRD, the Corporate Sustainability Reporting Directive, which is what we've based our whole business model on, because 10,000 companies will have to do comprehensive reporting by 2026. Those are the people we're going to be selling into, hopefully. What we try and do, Raul, is that we've created like an integrated framework where we've taken bits from some of these regulations and the stipulations and the criteria that they have. And we have automated tracking systems. So like we've already ingested 600 different regulations. We've ingested them in our AI. So we know exactly, based on sector, vertical, and so on and so forth, and region, which regulations will impact which companies. So for example, if you're Esso or BP, you might say, right, we're in Europe, which regulations will impact us? And then because of the sector, we've already laid out a series of those regulations. Simple stuff, but we've done it. And the question was, how do we keep up to date? I mean, it's a difficult question to answer at an AI level because the industry hasn't sorted itself out, right? There's a lot of politics in the industry. There's, to your point, Baby, there is almost a level of a bias in the cost of capital. Like some countries have figured this out. I'm familiar with a market like India very well because I do a lot of work there. Hydrogen, for example, the Reliance Group that I know extremely well, they have a board. Reliance is investing billions of dollars in really strengthening India's hydrogen capabilities, right? So they've gone, if you want to say hydrogen first, but that's what they've got. They've put all their chips on hydrogen to some extent. So, I mean, you know, we're trying our best to do data gathering of all regulations. We have automated trackers where we pick up which regulation is changing in what market. And what we're trying to do, the next product I'm building, it's a nice little sales opportunity. The next product I'm building is called Comply X, X being experience, where we're trying to automate compliance. So if you want to comply with a certain regulation, right now you have to rely on expensive consultants. Now you can go into a platform that will augment you, not replace you, ever, never replace you, augment you. And you can go on there and something called chain of thought. If you don't know what that is, just look it up. It's in generative AI. It's like a signposting system, step by step. It literally, we're creating a model that allows you to step by step auto-generate the template and the typical responses for certain sections of a directive or a regulation to save you time, money, and effort. So that's what we're really doing. And again, I want to say we're like first principles company. We're like doing back to basics work, not getting too carried away with AI and how great and imaginative it can be.
Good. Thank you very much. Now, Alex, I'm sorry, we are running out of time, so I'm going to ask you to be a little bit more brief in the next.
I'll be quick.
And in the final third question that I will run right now. So, Alex, in thinking about AI adoption, which is a big topic as well, as we know very well, how should the organization think about change management in this space?
Just very briefly picking up on one of the other, it seems that some of the discussion has moved a little bit, I guess, from the simulation to maybe the solution. We were talking about optimal outcomes. And, you know, if in some way, if we view AI as some long chain of kind of causal events, maybe going back all the way to sort of Newton-Raphson techniques, perhaps in terms of, you know, Lagrangian multipliers, remember those? In financial markets, you know, the solution is really important, really important. And one of the key things I think that we've learned is, whilst, you know, we might talk about optimal outcomes as being, and a lot of the early optimizers worked very, very hard to ensure that your solution was globally optimal. You weren't trapped in some little local minima somewhere, and your entire search space was covered, so the simulation takes a long time. But actually, it turns out, a lot of the time, you don't want the best outcome. You actually want the most resilient outcome. The solution that actually is able to provide the best outcome for market shocks, and a solution, particularly if we look at things like margin and derivatives trading, the configuration of financial assets which enable your portfolio to withstand market events. So I would draw people's attention to the fact that we're not always looking for global optimals to be the best solutions all the time in AI, but actually the most resilient outcome. So I think I just wanted to highlight that. I know we're short of time, so I'm going to hand back to Rahul. I'm sorry if I haven't answered the exact question, but I just wanted to get that point over. So thank you very much.
Thank you for that, because it is clearly with data from my simulations to solutions. This is the point. And also in the space of AI with a significant risk transfer and the risking, something that we are looking at the moment. It's all about as well, not only the simulation, but optimization of the risk, but that's anyway, we're not going to talk about it now. But Camille, let me address you the final third question, which is with your methodology about empirical game theoretic analysis. So how might AI integrate real-time data, carbon prices, ESG ratings, and so on, to adjust market policies on fairness strategies?
Yeah, okay, so this is where the simulations that we do are not, you know, the kind that they're customizable for whatever result you want. But essentially, the idea is to take economic principles, or as I was saying at the beginning, kind of mostly rational decision making of the agents, of the actors in the system, and then you run a simulation to understand what the equilibrium would be between them. And this is how we get those better informed conclusions on the kind of systems that we get. Essentially, the difference with the simulations is that in the simulations, typically, each participant uses fixed strategies, whereas here, the strategies are driven by the incentives. So it becomes a sort of incentive-compatible way of studying AI systems. And that's the kind of technique I was mentioning for the agentic AI bit. So how can data be used? Is, of course, through reinforcement learning, right? So what I said at the beginning, it's adaptive agents or adaptive strategies. That's how adaptiveness will come from. So if you have this reinforcement learning approach whereby you get data from the environment and then through AI you get the best next thing, could be the best way of bidding for carbon permits, or it could be the best way of setting the decay rate. So it can be used on both ends of the spectrum. That's one way in which smart data could be fit in.
Thank you. It will provide financial stability, I'm sure.
Yeah.
Good. Now, maybe the third and last question as well, connected with your two previous points. What are the biggest challenges in predicting carbon credit prices, and how can, in the context of carbon markets, of course, and for decarbonization with the new clean tech solutions towards net zero in carbon pricing, and how can AI tools help improve the transparency, the integrity of this kind of a price signal? And we can speak here about the AI tool as well on platform.
Okay, I'll be very short. I 100% agree with Alex on the suite of solutions. One thing that has accelerated the adoption of my solutions. The industry is providing them a suite of solutions, not just the optimal, and let them decide what they want, understanding the trade-offs. Now, on a global level, we need to get to net zero. Countries submit their nationally determined contributions. There is UNFCCC that is looking to establish a global carbon market that could generate some carbon credits to support developing nations, all nations around the world, in the adoption and diffusion of clean technologies, including tech and nature-based solutions. To drive that market, we need to set a carbon price or a credit price. What we've discovered is there is no market intelligence for these technological solutions, for all these deep technological solutions that could inform the modeling and the analysis on how to determine the price or the impact of the price. Because if the price is too low, then you need some derivatives. If the price is too high, well, that would be a win-win, but it's probably never going to be high. But we need to understand how to support that price in driving decarbonization. So what I'm doing, probably also marketing, is developing that market intelligence tool for deep decarbonization solutions to have a global focus with very country specificity, market specificities, plan specificity. We've been gathering the data for years. We just want to make it public so people can enjoy, making use of it, but also we ultimately want to be able to predict that carbon price over time from now till 2050. And that has to integrate the existing market-based mechanisms around the world. I know the UK and ETS are joining together, but there are 7 other emission trading schemes and 50 other carbon prices. So it's seeing how they can all work together to bring that pool finance for deep decarbonization.
Well, we are working on that in cement and steel industries.
Yeah, all the heavy sectors.
All the heavy sectors. I have to say as well that this morning I attended a very good call from Singapore as well. For instance, they want to make the phase out of the coal plants in Southeast Asia, and one of the key points is the financing of the phase out, the financing of that kind of transition, and carbon pricing plays a key role. And for that, we need this kind of market-based policy mechanisms to predict the right pricing for the transition credits, because that will be one of the avenues to finance the phase out of the coal plants. Anyway, now the final question as well, very quick.
I'll do it quickly.
As well. So, on scaling this innovation and affordability of this kind of fintech investments as well, but with the biggest challenges in net zero finance translating into scalable, affordable solutions, how does the Renaissance AI platform support policymakers, asset managers, and investors?
Right.
That's the challenge in the real life, in the business, no? Because
yes.
that is solutions and returns.
Yeah,
I'm in the risk management.
Yeah, I'm learning a few things. The first one is we should definitely collaborate, because I think you can't be solo when you're doing this work. You have to all sort of work in unison for us to really, if we're going to get to net zero, whatever that means, we have to do it in partnership. My first learning today. The second one, to answer your question, really is, just repeat the second part of it.
Yes. How does your platform support policymakers, asset managers, and investors? How the value proposition of Renaissance?
Oh yeah. So I mean, our message is really simple. We don't want cost or pricing to be a barrier to net zero, right? So if data is really expensive and only people who are really wealthy and companies who are really large can afford it, I guess you're going to see the opposite of equilibrium in society. It's not very democratic, right? So our mission and our job, it's a very small role we play, but an important one, is to make this data, if I could make it totally free, I would, but we're going to get nearly close to free. So anyone and everyone can actually afford this data, so they can do modeling on it, right? The clever people can use it, integrate it into their regression models or various other models that they have. So we can try and figure out what are the possibilities. And one of the products we're also developing is called PredictX in a year's time, where we're taking all of the raw data and we're looking for correlations and any causal links, if at all, between business performance and ESG performance. So this is what comes up a lot, and you probably see this, right, in asset management, comes up a lot where companies say, look, I'm not going to do this ESG stuff. I mean, look at the United States. I just came back from NYC. I mean, it's a train wreck, right, because of what Trump's done. People have pretty much pull back on ESG. I'm doing venture capital raise. They're like, oh my God, ESG, we don't do ESG. Instead, what they're doing is, by the way, you probably know this, they're calling it something else, like DEI. So now it's probably going to be called, MIT is working on this genius model, it's probably going to be called something along the lines of responsible intelligence or something like that. So, you know, we spend our lives doing all of this marketing stuff, but yeah, I mean, talking about, answer your question, I'm trying to make it affordable. It's as simple as that. And with Gen AI, you can, period.
Okay, no, thank you. Thank you very much. Alex, in your experience, how do successful organizations plan for adoption? We see the adoption plan for until change and looking for implementing AI solutions, which is the big challenge as well.
It is a very big challenge. I think there is a lot of fear in organizations. There is tension in organizations. I think certainly in terms of intergenerational tension, I think that's the biggest tension I see. I think a lot of you know, Gen Zers, Gen Alphas, you know, come into organizations preloaded, you know, very familiar with a lot of this tech, maybe using it on a very frequent basis. The opposite end of that scale is probably, you know, a lot of leadership in organizations who are less familiar, probably not using this type of technology at all, and don't probably understand what questions and what capabilities are even possible. So I think that the biggest tension is really this intergenerational tension that I see brewing in a lot of companies. And, you know, how do we demystify that for people to actually help, certainly, you know, smaller and maybe mid-sized companies actually bridge that gap. So I think that's one of the key tensions that I observe on a frequent basis.
No, thank you for that. Well, and one of the risks is not to do anything. That would be a risk as well, and to leave left behind.
I think it's was it the saying, evolve or die? I think
yes.
is the phrase that jumps to mind. I think those firms that do evolve will succeed, but those who don't will not succeed, sadly.
Now, I would like, sorry, my apologies for this because we could be talking here for an hour. I would like to open the floor for a couple of questions. Yes. Okay. Thank you. So,
It's up to him, yeah.
No.
It works, huh?
My voice is very loud. Hello?
yeah.
That's
Yes.
me.
Okay, so first of all, thank you. I would like to thank the panel. And I have a panel question, but it's containerized with something you could call a short preamble. So artificial intelligence and machine learning has been used for climate modeling, protein building, market intelligence, and all those applications. This allowed us to discover more efficient materials that have indirect applications for sustainability and net zero. We know these general applications, but not direct and explicit applications in net zero and sustainability, not purpose-driven. So my question is, besides the intuitive and concrete examples of AI/ML applications in market-based finance, what applications can be truly transformational for sustainability? Let's take for example, a proof of concept to real-world deployment within the next 5 years. Because in my experience, private capital won't move without a plan and an incentive.
Okay. Who would like to address this?
So yeah, I was struck, you're probably better not using the mic because I think your voice was much better without the mic.
I agree.
What was the last part of what you said? Sorry.
Yes, basically my question was, besides the intuitive and concrete examples of AI/ML applications in market-based finance, which actual implementations, actual applications, can be transformational for sustainability, taking it from proof of concept to real deployment within the next 5 years, because private capital won't without a plan or a
Okay. I can start with a small little example, just a startup example, right? I always give you the stuff that's about building stuff. So one of my closest mates has been in ESG, if you want to call it that, for a number of years. And he's built many companies, and one of the companies I invested in the IoT space, Internet of Things space. And what he's doing right now, which is a small example of pragmatic solutions, but it's more around the side of a dual value. So he's created a bunch of sensors where you, in buildings, any building around the world, hotels, he's got loads of Accor hotels, Hilton, Marriott, they're his clients. In all of these hotels, they put different sensors and chips to turn off the lights, so it's a sensor-based lighting system. You know, the TV is on some green sensor energy model as well. Electricity is being measured, you know, even the water supply, they've got sensors inside the pipes, so on and so forth. He's been doing this for a number of years. The last 10 years, he's been really struggling. But the last I would say year and a half, 2 years, he's seen an uptick in his business. So why I'm telling you that is because I reckon, I'm just giving you an example off the ground, he's been struggling, raising capital, no one's really buying, he's got the best solution, multi-sourced it from all parts of the world. Cheap solution, actually, because he sells it in markets like India and continents like Africa. So it's affordable, but the buyers haven't really responded. It's only in the last year and a half, suddenly out of nowhere, they've gone crazy and his business is thriving. And what he's really doing is he's providing the data, so he's got a software layer, application layer, he's providing the data around the energy management in hotels of lighting, for example. That's one of the categories. That is a very pragmatic way of feeding the core data set that a company, somewhere in a company, someone's tracking all of the disparate data that they're pulling out of energy management, and then using it to provide people like us, eventually in an ESG report, the best quality of data. So I think if you think of it like, again, supply chain or the value chain or the upstream, downstream, you've got to have a really good group of startups or established companies who are building a top quality, you know, AI, even hardware. We haven't talked about hardware, but hardware is a very important aspect of this because it takes materials, and it's really damn hard to build hardware that's green. I mean, it really is, unless you become a big, huge industrial company. So I'd say, to answer your question, there are loads of solutions out there. My last company was a startup data company. I used to track 1 million startups in different domains, and one of the domains was actually energy management. And IoT is, and so I'm a big believer in IoT and sensor-based technologies. I think that's out there, it's been out there for a long time, and it's a great data feeder for global organizations.
In response to your example of your friend's company,
Yeah.
would his business not take off had the energy price been very low?
It's a good question.
Good question, and you're right, possibly,
Yeah.
possibly, because it's human behavior, human psychology, and also business drivers. It probably wouldn't have. Now I don't know. I've got smart people around me. Why has his business suddenly thrived over the last 24 months? Could be regulation, cost of energy, could be many factors, but it's doing much better than it did 8 years before that.
We would like to think that it's because people are very conscious of that.
Yes.
Yeah, you'd like to.
Second question, please.
Hi. First of all, thank you. Amazing contribution, so really enlightening. My question is about governance. I think in the past 15 minutes, the theme, whether we call it out or not, was governance. You talked about governance in ESG, but more importantly, there was a lot of hints at governance of AI, which means trust, which means ethical AI, and there is a lot of research out there that says that lack of trust is one of the main reasons why AI doesn't scale. So my questions to you is, what is your approach to governance in AI, your thoughts, but also you talked about how scary agentic AI, which can make decisions for you, can be. Do you think that with the appropriate governance on top, it can be less scary?
Okay, so I'll take the second one, okay? Because on the governance, I think is better equipped. Yes, the short answer is yes. But my fear is that the rush towards economic advantage that will come from the optimization that multi-agent or agentic AI will achieve will not allow us to come up with the governance models early enough. So potentially yes, but I don't think we'll have the time.
Yeah, I can chime in if you want. So we call it responsible AI, and so as a business we have to think about ethics bias, especially bias in our models. And we follow the EU AI Act because we're going to be selling into the EU. The EU AI Act is very complicated, so apparently now you need an auditor to audit a company, and that costs money as well. So I think why I'm mentioning that point is adoption of regulations and the pragmatic outcome of good governance. It remains to be seen. I don't know the answer. As a startup founder, I can tell you I don't know how I'm going to do it. What I am doing, though, is let me start from the core. My team is diverse. So when you build AI, one of the problems with AI is that if you have a monolithic or a homogeneous team, all white men, all black men, all Indian men, whatever, women, then you will see some problems in your data sets, even the coders. I mean, I have a live experience of bad AI in my last startup, where I had a bunch of coders who were all men of Asian background in India, and it was interesting, the code that was being thrown out in my data sets was biased. We only realized that it was irresponsible AI. Now, we never really called it that. We were like, this looks a little bit funny, the data set. You have to, so what we're doing is we've got a diverse team of people in our company, all backgrounds. And diversity for me, by the way, I'm a big proponent of diversity. I would respell diversity because it's linked to responsible AI, because you can have diverse AI as well, different LLMs and stuff, different data. Diversity should be spelt with a T-E-E, not a T-Y. And because the T should be thoughts, diversity of thoughts, the other E should be expertise, and the final one should be experience. That's what diversity is actually about. Race and gender is a byproduct of that. It's not the other way around. And that's why DEI has taken a battering off topic, but I just had to say that. And but AI governance is critical to every organization. We follow methods, there are a whole bunch of frameworks you can follow. And we also have a mechanism in our business where we look, so we use, for example, if you use external LLMs, Claude in particular is very, very good at bias detection in text. So if we're using OpenAI, we use OpenAI and then we wrap Claude on top as a bias agent to look for any bias in the text, because we're doing compliance work as well. So these are small little hacks, but I can talk to you about it offline.
So one last question, and we have to finish. Yes, please.
Super. Is the mic better?
No, that's good. Mic's good.
Oh, affordability, fantastic. It's a small set of questions, primarily from Ms. Baker and from Professor Bender, related to the application of AI in finance and specifically deployment of it. You mentioned that the financial sector has fears of hallucinations and reliability of this technology, but the question is, shouldn't this be benchmarked against what is the error rate of humans doing similar things? Because financial analysts do say bullshit and make stuff and make up numbers. So the question is, what's the rate at which the error rate of the AI is going to be acceptable in a financial application? And also considering speed and cost. And similarly, in terms of agents, you mentioned that the communication of agents compounds errors, which is definitely true, if you take the output of an agent and you pass it to the next agent. If instead you have an iterative review of the output of an agent, you can instead look at recursive improvement rather than compounding error. So that perhaps is an argument for an agent crowd could improve outputs instead of necessarily degrading. And overall the question is, was this discussion based on the current state of the art, or how we actually take into consideration the rate of improvement of this technology? So all of these issues that were mentioned in terms of reliability, will they actually be an issue 3 to 5 years from now?
So the first part of the question, do you mind repeating the very first part of the question for me again? Do you mind? Sorry.
The benchmark.
I was trying to understand the issues which financial professionals are raising about the reliability of the AI. How much are they actually issues when they should be benchmarked against human performance, and what is the rate of errors for humans?
I see.
And possibly, what is a good signal when you could say, okay, at this level, we would adopt it in mass?
Yep, I get the question. I mean, in short, like, no rigorous financial institution is supplanting human judgment in investment, pipelines. I mean, if you're credible, in short. The ability for humans to make judgments, or at least remove a part of the investment process that maybe involves collating lots of information together, I think is an efficiency benefit. I think what we are seeing is, a kind of seismic change in the market in terms of, certainly if we look at, for example, in credit, a large part of the credit space involves, producing reports, looking at financial analysis, looking at forecasting. There's a seismic shift occurring in that market where agentic AI is assisting to collate that. What pressures will that create? Well, it'll probably create pressures where when people, look at deal flow, for example, if 95% of the market can look at that deal flow and analyze it in a week, and you take 3 weeks, then, well, clearly you're not going to probably get on that deal. So I think as it becomes the norm across the market, everybody has to come up to the same standard. So I don't think it replaces human judgment. I think it just acts as an aid. But certainly the trend that I see is that benchmark of everybody having to change is firmly underway. I mean, this shift it's started already, essentially.
Yeah, and I agree on this point. From what I've seen, the AI tools that we develop, they tend to be used as another tool in the toolkit. And also the other big problem, I think, it's we've learned how to measure financial risk. Now we're adding another risk to the picture, and we don't know how to measure that as well yet. So coming to your question, it's not a given that a multi-agent system or an agentic AI will lead to better outcomes, right? So as you said, if you design the multi-agent system in a certain way, maybe it's only beneficial. But what I'm saying is, when you deploy this set of agents, you can't just trust that because you thought you thought it hard about it, and you said, no, this is going to work. The emergent behavior of this system of agents is going to be what you want. There's going to be some behaviors of these multi-agent systems that you can't predict. So what I'm arguing is that we should have a better understanding of this risk and minimize it, and try to engineer outcomes we're comfortable with.
Okay. So now we have to finish.
Yeah.
Sorry, apologies for that. I'm not going to address the open question I had ready for our speakers. And with the authorization of the Institute for Artificial Intelligence from KICS, I believe this kind of open question for a potential roundtable about the next frontier for AI in the context of net zero asset finance. So I believe this for a roundtable.
Yeah, exactly. So maybe ask your LLM for an answer to this question. Huh?
Yeah.
Yeah. So you have the answer with the LLM.
No.
Not with humans.
Okay. And anyway, I would appreciate you could make an assessment with a QR code about this kind of session that we have right now. And an assessment.
Yeah, so there's 2 QR codes here. One on the right, which would be quick feedback on this particular event, and the QR code on the right is for the remainder of the program. We end on Saturday. Tomorrow it's mainly AI and Education Day. So, I'm not sure how many of you are interested in that, but if you have kids, maybe it's important to understand how AI is going to change education. And on Saturday we have Family Day. So if you have kids and you'd like them to play with AI, come by on Saturday. And thanks a lot for coming and staying with us longer than predicted, but I think it was a nice discussion. And let's thank all the panelists again.
Thank you very much.